Hello, financial enthusiasts! Welcome back to Stock Market Catalyst, where we reveal the secrets to financial success and building a solid foundation for a brighter future. In today's video, we're delving into the captivating realm of options trading. Whether you're an experienced investor or just beginning your journey in the financial markets, learning about options can unlock a wealth of opportunities for your portfolio. Options trading may sound complex at first, but fear not. We've got you covered with simple explanations and real-life examples to help demystify the world of options. By the end of this series of videos, you'll have a solid foundation to confidently explore various option strategies and discover how to navigate the market with confidence. So, what exactly are options and why do they exist? Options offer incredible opportunities to mitigate risks, amplify gains, and trade with less capital than traditional stock investments. They're like the Swiss Army knife of the financial world and will show you just how versatile they can be. Don't worry if this seems confusing at first. As we go along, we'll explain more terms and use examples to help you understand better. Feel free to take notes so you can refer back to them later. Let's continue learning together. Options are contracts that you give the right, but not the obligation, to buy or sell a specific stock at a pre-agreed price on or before a certain date. You can either buy an option, which gives you the right to do this, or sell an option, which means you're giving someone else that right in exchange for a payment called a premium. There are two main types of options: calls and puts. A call option grants the option holder the right, but not the obligation, to purchase shares of a stock at an agreed upon price on or before a specific date. On the other hand, a put option functions similarly, but it gives the option the right to sell shares of a stock at the agreed upon price on or before the specific date. The agreed upon price is known as the strike price, and the specified date is called the option's expiration date. Now, let's put all of that in simpler terms. Imagine you bought a call option, which means you're the option holder. The strike price for this call option is $120 and it will expire in 30 days. Owning this call option gives you the ability to buy the stock at $120 anytime during the next 30 days, regardless of where the stock price goes. For instance, if the stock price shoots up to $135 within the next 30 days, you'll be in luck. Your call option allows you to buy the stock at $120, even though its current market value is $135. Now, let's consider a put option. If you bought a put option with a strike price of $120 and an expiration of 30 days, it works in the opposite direction. This put option allows you to sell the stock at $120 anytime during the next 30 days, regardless of the stock's market movements. Here's why this is beneficial. If the stock's value plunges to $100 per share during this period, you still have the right to sell the stock at $120. So, even though the market value is $100, your put option secures a much better selling price for you than if you were to sell at the current market value. In essence, both call and put options provide valuable opportunities to capitalize on potential price movements and secure favorable buying or selling prices. So, why would someone want to buy an option? Let's start with a put option, which gives you the right to sell stock at a specific price on or before a particular date. To understand this, think about purchasing insurance for your dream car. Imagine you just bought a brand new Ferrari and you want to protect it. To do so, you go to Flow from Progressive and purchase insurance. This insurance provides financial protection for your Ferrari in case you ever get into a crash. Now, buying a put option is quite similar. It acts as a form of insurance for your stocks. If you own some stocks and want to safeguard their value in case the market takes a downturn, you can buy a put option. This put option serves as financial protection, allowing you to sell your stocks at a specific price even if the market value falls below that level. In essence, purchasing a put option is like buying insurance for your stocks to shield them from potential losses. Imagine you're an investor and you recently acquired 100 shares of XYZ stock at $125 per share, making your total investment cost $12,500. As we all know, stock prices can fluctuate, and in the worst case scenario, stocks can become worthless, potentially causing you to lose your entire investment. To safeguard your investment, you can think of it like purchasing insurance for your car. In this case, you can buy an option contract known as a put option. By buying a put option, you gain the right but not the obligation to sell the stock at a predetermined price on or before a specific date. So, let's recap. As an investor, you own stock. And to protect your investment, you choose to buy a put option. This put option serves as insurance for your stock, allowing you to sell it at a fixed price if needed, even if the market value drops. When you buy an option, there has to be a seller on the other side. This seller can be any other trader who is willing to accept payment in exchange for taking on your risk, much like an insurance provider. In essence, this is the core concept of options trading. An investor faces certain risks but is willing to pay someone else to assume those risks for them. The person who sells the option in turn takes on the risk that the investor had initially. In simpler terms, options involve the transfer of risk between traders, allowing investors to mitigate their risks by paying others to shoulder that burden. Now, let's look at a real example. Imagine you invested $12,500 in XYZ stock, and as a safeguard, you bought a put option to act as insurance. The cost of this insurance, the put option, depends on various factors, which will be explained in the third part of the video. For now, let's assume you paid $500 for the put option, providing you with comprehensive coverage as insurance for the next 30 days. This means that during this period, you have the right to sell your XYZ stock at a predetermined price, ensuring protection against potential losses should the stock value decline. Now, let's look at two different scenarios. In the first scenario, after purchasing both the stock and the put option, the stock price rises from $125 per share to $132 per share. This means you made a profit of $7 per share on 100 shares, totaling $700 on the stock you own. However, keep in mind that you also paid $500 for the put option, which now has no value since the stock price went up. As a result, your net profit is only $200. You might feel like it's a rip-off, while the person who sold you the option is happily saying thanks for the easy money, as they got to keep the $500 premium you paid them. Let's consider the second scenario. In this situation, instead of the stock price going up, let's say it goes down to $113 per share. This means the stock's share price is now $12 cheaper than what you initially paid for it. With 100 shares, your total loss amounts to $1,200. Thankfully, you bought a put option as insurance for your investment. So, you approach the person who sold you the option and remind them of your contract. Now, even though the stock is valued at $113, you have the right to exercise your option to sell your shares at $125 per share. As a result, you haven't lost anything on the stock itself. Your only loss in this scenario is the $500 you paid for the put option. This is a much better outcome compared to the $1,200 loss you would have experienced if you hadn't purchased the option contract. Now, remember that the person who sold you the option had an agreement with you. They were obligated to purchase your shares from you at $125 per share. In this scenario, they kept the $500 premium you paid for the put option, but now they are facing a $1,200 loss on the stock they own. At this point, they have two choices. They can hold on to the stock and hope its value goes back up, or they can sell it at the current market price of $113, resulting in a total net loss of $700. That's all options are, folks. They serve as simple insurance for an investor, and that's precisely why they exist in the first place. They provide a valuable tool for investors to protect their investments from potential losses in uncertain market conditions. At this point, you might have some thoughts crossing your mind. You could be thinking, I don't want to purchase insurance for my stock portfolio. Or if you don't own any stocks, you might be eager to learn option strategies that require minimal capital and don't involve owning the actual stocks. The good news is that you absolutely can do that. Options have a fascinating feature. You don't need to own any stocks to trade them. Instead, you can simply trade the changing option prices through your brokerage account just as you would with stocks. However, it was essential to lay this groundwork because comprehending the connection between options and insurance is vital. This understanding forms the basis of comprehending how options are priced, a topic we'll explore in the upcoming videos. By now, you grasp that buying a put option is akin to purchasing insurance for a stock investment, while selling a put option is similar to selling insurance on a stock investment. Let's explore another reason someone might want to buy an option, specifically a call option. This time, we'll explain why you might consider purchasing a call option. Imagine you don't currently own any shares of a stock, but there's a particular stock you really like and want to invest in. The only hurdle is that this stock has a high price tag, requiring a substantial amount of capital to buy shares outright. In such situation, an alternative approach is to buy a call option. By purchasing a call option, you pay a small premium for the right to buy shares of the stock at a later date if you turn out to be correct about the stock's price increasing. Essentially, purchasing a call option allows you to speculate on the stock's future price gain without committing a large amount of funds up front. It provides a low-cost option to obtain exposure to a stock you like, with the possibility for returns if the stock price rises. Let's consider an example. Currently, stock XYZ is trading at $125 per share. If you were to buy 100 shares of this stock, it would cost you $12,500. Instead of investing $12,500 to buy the stock, you have another option. You can buy a call option with a strike price of $125 and an expiration period of 30 days. This call option grants you the right to purchase 100 shares of the stock at $125 per share anytime during the next 30 days. Now, the price you have to pay for this call option will depend on various factors, which we will cover shortly. For now, let's assume you paid $100 for this call option. Let's consider another two scenarios. In the first scenario, after purchasing the call option, the stock price rises from $125 to, let's say, $137. Since you own the $125 strike call option, you have the choice to exercise it now. Exercising your option means you're taking advantage of the right to buy the stock at a lower price. So, in this case, you decide to exercise your $125 strike call option, and now you own 100 shares of stock at $125. With the stock price up to 12 points, you've gained $1,200 on this stock. However, don't forget that you paid $500 for the call option, so your net profit is actually $700. At this point, you might be thinking that if you had simply bought the stock from the start, you would have made more money. And that's true. But let's quickly explore one more scenario. In the second scenario, the stock's price goes down to, let's say, $100 per share. You own the $125 strike call option, which you purchased for $500. This call option grants you the right to buy the stock at $125 per share. However, at the current market price of $100 per share, it wouldn't make sense to buy the stock at $125. Luckily, you're not obligated to do so because that's the essence of a call option. It gives you the right, but not the obligation to buy the stock. So, in this case, you simply lose the premium you paid for the option, which was $500. If you had bought the stock at $125 instead, you would currently be down $2,500. This is the advantage of buying an option rather than directly buying the stock. You can invest less capital and therefore carry less risk. However, in exchange for this benefit, you need to pay a premium for the option. By the way, you can also trade options in a similar manner. If you buy a put option without already owning shares of stock, you are essentially betting that the stock's price will go down. If you exercise your right to sell stock that you don't own, you will end up with a short stock position. In summary, buying a call option means you are betting that the stock's price will rise, while buying a put option indicates you are betting that the stock's price will decrease. Before you rush into buying calls for every stock you believe will rise and puts for every stock you expect to fall, hold on. There are significant downsides to such a strategy, but don't worry, we'll introduce you to much more effective ways to trade options. One important point to remember is that you don't have to actually exercise your option contracts when you trade them, as we demonstrated in the examples earlier. Instead, you can buy an option and then sell it later, ideally at a higher price than you paid for it. And that brings us to the conclusion of our options trading series part 1. So, if you're ready to embark on this exciting journey of investing options, hit that subscribe button and don't miss out on the next part of our options trading series, Investing for Beginners Options Trading Part 2. While you wait for the next update, you might want to look into Understanding Options, a Beginner's Guide, which digs into the world of options trading to help you get started with this financial tool.